In this video, we're going to introduce you to one of the most simple yet powerful income and growth strategies known to man, the covered call. This tried and true strategy is one of our favorites because we can plan, execute, and manage this trade in less than 1 hour a month. Best of all, we can approach this strategy with a professional mindset and invest like a business would. And like all good businesses, we need a balance sheet that helps us to track our income and our expenses, as well as take and keep inventory of our assets and liabilities. Now, one of the first lessons the savvy investor will learn is that we want to buy quality assets, like fundamentally sound stocks, preferably a stock that can generate growth and income through quarterly dividends. Now, when we buy an asset, like your favorite stock, it goes into our asset column, and there are two ways for an asset to increase our net worth. The first is for the asset to increase in value, giving us a capital gain, which would make us very happy. And the second is for the asset to pay a dividend, which is income, which also makes us happy. As you can imagine, we can use this income to pay our expenses. We can pay off debts or liabilities, and naturally we can reinvest the income and start compounding our gains. All of this is a no-brainer so far. Now comes the fun part. When you own a quality asset like your favorite stock, you can take your income strategy one step further by learning to sell options contracts on the stock shares that you already own. Now, an option is a contract, which is an agreement between a buyer and a seller, which gives the buyer of the contract a right and the seller of the contract an obligation to buy or sell an underlying asset like your favorite stock at an agreed upon price called the strike price on or before an agreed upon date called the expiration date, all in exchange for a premium. Now, we love premium because we can generate regular income and or compound our gains with this strategy. When we sell a call option contract, which is a promise to sell our stock, typically at a higher price than we paid for it, we collect that premium and we get paid because we made a promise, which is an obligation that lasts as long as the contract stipulates, which in this system is about every 30 days or so before the option contract expires. Now, there are three possible outcomes. The stock can go up, down, or sideways. If the stock price rises above the agreed upon strike price, if that happens, we keep the premium and will deliver the stock at the agreed upon price, which is a win-win. If the stock price stays sideways until the option expires, then we keep the premium and we also keep the stock. If the stock price falls, we also keep the premium and the stock as well. Pretty simple, right? If at any point in time the contract gets exercised and we get called out, we will go ahead and deliver the stock at the agreed upon price, and then we will turn around and reacquire the stock and then repeat the process, writing covered calls and collecting monthly premium. Ka-ching, ka-ching. And that, ladies and gentlemen, is a quick introduction to the covered call. In our next video, we'll dive a little bit deeper into some of the details.